Good morning and welcome to Market Outsiders. It's Wednesday, August 27th. My name is Naman. I'm joined by my colleague and co-host Jenny Ray. And we are back today to break down some breaking business news. Before we get into that, Jenny Ray, how are you today?
I'm great, Naman. It's so good to see you. I'm excited to dive into what we're talking about today. And I feel like the more that we do this, the more I'm seeing business news that I think of from a different angle. So I'm really enjoying just the general conversation that we're having. Honestly, I'm also super glad that we're releasing this podcast the day after Taylor and Travis announced their engagement. I think the one thing that you learn in the biz is you never want to compete with news cycles. And when T Swift drops some insight like that, congratulations to the happy couple, by the way. I think that it's super important that you don't compete with it. So today we're going to talk about something I think that is super interesting, but I feel like yesterday you just you have to play your cards right, you know?
We were strategically off yesterday. By the way, future episode idea that just came to me, we got to do an episode on the economics of that wedding.
Oh, absolutely. I
But
mean,
for today,
P.S. Just so that you know, the dress that she was wearing in the picture sold out within minutes of posting.
wow, okay, I did not see that. I'm not surprised, but I did
I
not
know.
see that news.
Ralph Lauren, $499. You could have gotten it yesterday if you had seen it fast enough, but now you can't. The
So like
Cartier
within the
watch,
first 20
however, was
minutes.
still the $10,000 Cartier watch was still available at press time.
Okay, great. Well, don't tell my wife that.
Look, it's cheaper than T Swift tickets, so honestly, like I feel like there's options. So yeah, but that's a future episode, y'all. We're gonna get there. Today we're
We'll
gonna
get
talk about
there.
something that I think is also super fun. You ready for this, Naman?
Let's do it.
Okay. Love this news. This was sent to us by a listener. And so I think we should just dive into it today. Dr. Pepper takes a shot at Nestle with an $18 billion takeover of the Dutch coffee giant. It didn't make headline news for me yesterday. And so I thought, let's actually do a little bit of a deeper dive and walk through it today. I also just think like this is exactly the kind of thing that we want to talk about on the pod. So thank you so much for sending this in. But I wanted to just talk a little bit about this. What Dutch coffee giant are we talking about? So, JDE Peet's, publicly traded, and as many of you will know, has both a store front presence as well as a coffee line. The deal represents a 20% premium to their stock. So we've talked a little bit about deal mechanics before, about why you offer a premium, about how that often will push something through a board depending on whether it's activist or not. These kind of premiums usually come from that level of a premium usually comes from strategic buyers, somebody else who believes that they can afford the premium because they have synergies on the back end that they can use to pay it back. Whereas somebody like a private equity firm is going to be a little bit more hostile, or they're going to go to a company in an earlier stage. Even private equity take privates are a lot less frequent than they used to be, because the goal is often to flip them in this kind of deal. I think that some of this kind of headline news is also interesting, so I'm just going to run through it. Aman, get your early take, and then we can dive into some of the numbers. But they are planning to split coffee from beverages. I think that one of the things that I have never in my life understood is why Keurig Dr. Pepper became the name of a brand. Like, honestly, this to me makes sense. It's almost like they just said Keurig was too small to be separate, so now it has like a big uncle that they're putting with it, and so JDE Peet's is going to be a part of the coffee brand with Keurig, and then Dr. Pepper will be a standalone business once again. And then, right, KDP's US listed shares went down 7%. So I also want to explore, like obviously this represents a premium to the business. That premium didn't get met in the trading of the business itself. So somebody in the trading world, is not believing that this deal is going to be as good for the businesses as they do. Their internal models are basically are showing outsized impact. But the other thing that I just want to talk about is what the future is going to look like with Nestle. So that they did a good job of kind of covering some of the highlights. Quick hot takes before we dive into some of the numbers.
Yeah, Jenny Ray, this looks like a deal to undo a deal. So Keurig Dr. Pepper became a thing in 2018. Now you acquire JDE Peet's and you're going to split the business back up again. I agree with you. I can absolutely see both revenue and cost synergy opportunities if you're gonna, kind of combine Keurig and Pete's into one entity. It was always a little bit, I think, of a tougher sell to find at least revenue synergies between like Dr. Pepper and like, I don't know, at home coffee, right? At home coffee pods, right? Like those are, yes, they're both beverages, but you know, uh, they don't really seem like synergistic businesses. And so, yeah, my high level key takeaway is they had to do another deal to get out of the deal they made 7 years ago. And now what you're seeing is they're paying a 20% premium on Pete's. They must have thought the valuation on Pete's was so attractive that they were willing to pay a 20% premium to where the stock is trading in Europe. So that's like kind of my secondary takeaway. You were just talking about their own internal models. Like they are seeing some kind of right either revenue or cost synergy opportunity here that prompted them to say, you know what? Not only will we like, are we going to pay kind of what the shares are trading at today? We're going to pay a 20% premium on that price too. And so, I've seen elsewhere that they believe that they can unlock $400 million in annual cost savings. And so maybe their internal models show that like, if they're able to achieve that, hey, you know what? The valuation will be 20% higher. Count me skeptical if they're going to actually be able to achieve that. I think that's what the market is saying too. When you see Keurig Dr. Pepper's stock price drop 8% in one day on this news, I think that's just an acknowledgement from the market of something we've said here before is that, transactions like this rarely work out. And that's, there's just so much that has to go right in terms of kind of the timing of the deal, the valuation of the deal, the strength of the management team, right? Like there's a lot of variables at play here where the default answer for a lot of these transactions is you're not going to achieve what you think you're going to achieve. I think the market knows that. So it's great for Pete's shareholders. They're getting a 20% premium for nothing. But I think Dr. Pepper shareholders are saying, hey, hold on, pump the brakes here a little bit. Like you frame this as an opportunity. We think that this is a risk. And obviously we'll see how it pans out.
And I think one of the things that's super interesting is that they're acknowledging it, like you said, in this deal, you'll see that they're planning to spin them out into two, not just two different divisions. It's not going to be a coffee division, like two completely
Two different
separate companies.
companies.
So you're actually looking at a share transaction that is going to basically take value away from the Dr. Pepper business and the Keurig business and pop it into this business. Basically, what they're saying is like the sum of the parts was actually greater than the parts themselves, right? I think here what you're seeing is that exactly like you said, they probably weren't as good at the first takeover, and the market is acknowledging that there's some inflated estimations going on with this takeover as well. One of the cases that I love to give is a competitive case, and I love to do it in case interviews. And I always make sure I jab in there that like one of your competitors is looking at this deal, and everybody tries to come back with the same exact psychology that I see at play in the market all the time, which is like, well, if our competitors want it, we probably need it too. I don't know if Nestle was on the hunt for Pete's as well. I don't know if this was actually, a hostile takeover. So we'll do a little bit of digging. But what I'd really love to see is actually the backstory and the news from the Keurig Dr. Pepper deal. And I think that's something that would be the first thing that I would want to go look at if I was advising on whether or not to do this transaction was how good were we at the last one and what synergies did we actually realize? And therefore, like, how can we level set what we think the actual synergies are here and be realistic about it? Because when you look at Keurig and Dr. Pepper, some of the synergies that they might have had would have been distribution synergies. From my memory, when Keurig was acquired by Dr. Pepper, Keurig and Dr. Pepper were in nearly the same number of stores. So then it's maybe a little bit of a shelf space play, but then you're kind of like, well, if it's not revenue oriented, then what are the cost synergies? Sure, both of you are manufacturing a food product, but what's the difference between coffee and ketchup? Like, why not just like Heinz Dr. Pepper or right, like Keurig and some kind of other like granola bar, right? Like if you kind of make those types of leaps to try to come up with the synergies, you can see that's potentially part of why the market was skeptical. I also just think like creating that brand Keurig Dr. Pepper, like I never wanted to say it. I never wanted to like it just didn't make sense to me in my brain. Like the two brands didn't fit together. Coca-Cola has never been like Coca-Cola and all of the other labels underneath it. Like it just didn't seem to make sense. And it seemed like they were giving up something in that process that meant that the business was not as solid of an operator as you might have imagined. So let's just talk a little bit about some of the transactions. First of all, this didn't hit my news feed yesterday, but it says it's Europe's largest acquisition in more than 2 years. So I think you have to remember, like, there are all kinds of regional transactions, and this is not small, by the way. $18 billion is still enormous. But there are all kinds of transactions that are happening, and whether or not they hit the news and whether they're being covered in the market are two very different things. So this was in the news, but I really appreciate our listeners sending it to us because it wasn't actually at the top of the feed based on other political news and, of course, T-Swift yesterday. But then this transaction, right, comes as the global trade war intensifies. You mentioned this. They're saying it's not revenue oriented, right? It's $400 million in annual cost savings. So would you just run us through what some of the cost savings might be? Like if we were like, hey, we need to build a model and we have 2 weeks to do this, where are some of the places that you would first look in a deal like this, Naman?
Absolutely. I think, the first place I would look is supplier power, right? Now I've got a combined entity, right? I've got more leverage with my suppliers. I can extract better terms from them. That'd be the first place I would look. The second place I would look would be distribution. I can now combine the distribution of those two entities, and get kind of Pete's into the places where I've got Keurig in right now, and Keurig into the places where I've got Pete's in right now. Like those are really the two main places I look. I guess third would be manufacturing, but I'm a little bit unsure about that because I could see like you need like a different setup, manufacturing setup to like put like coffee grounds in a pod versus like maybe process whole beans or ground coffee. But I'm sure that there's some like footprint consolidation that can happen where, you can now start to produce, right, like finished products for Pete's and finished products for Keurig, like in the same kind of physical locations. Those are the top three things that I would look at to try and unlock some cost savings. I'm sure there's more, but that's where I'd start.
I think it also has to be this kind of fascinating combination, like you said, of on the distribution side, of a big product question, right? Like, do you currently have any product overlap, and do you want product overlap? The more you have product overlap, right, the more that you have Keurig in bags and Pete's in bags, and the more that you have single serve Pete's in Keurig cups or in other, single serving modules, the better the synergies are, and the more complementary they are, there just are fewer synergies. I would also just look big time to the back office. And I don't know how lean or strong they are. I think part of why the market maybe doesn't look at this is that I think that like an analyst would be like, how is Keurig Pete's going to be synergistic? Whereas I think the hypothesis again was that like Keurig Dr. Pepper was supposed to already be maximizing those synergies. So how do you wring more synergies out of a back office deal like that? I don't know if you can, but anyhow, you might look at something like an accounting function or a legal function being able to be covered by both. You lose some of those benefits if you separate them into the two operating companies, right? The coffee business and the Dr. Pepper business. By the way, are you a Dr. Pepper drinker?
I am, not consistently, but I am. I like Dr. Pepper. It's the number one soft drink in Texas, actually. So dominates the market in
Higher
Texas.
than Coke?
That's right. Yes. Dr. Pepper, the
does
formula,
Topo Chico
I believe,
count?
Topo Chico is a different thing. But what do you think about soft drinks? Dr. Pepper dominates in Texas. I believe it was actually formulated in Waco. So it's like a Texas-born formula. And so for the last 150 years, that's been the pop or the soda of choice where I live.
Okay, fantastic. This is what we come for, Naman. These kinds of fun facts that you hold in your brain and you don't share them anywhere except for trivia night and here on the pod.
I've got to have an incentive. The world is run on incentives. If you've been listening to this podcast for any amount of time, you know that. One thing I do want to mention though is the fact that they're splitting these companies up, right? Like coffee and soft drinks. It actually makes more sense to me than KDP did in 2018. And 100%. I think it's an acknowledgement that, hey, like these are two like similar but different businesses. and we haven't been able to wring out the synergies that we thought we were going to be able to 7 years ago. So let's go ahead and just like split the company and do soft drinks and carbonated beverages on one side and coffee on the other side. And let's just really have each entity focused on the one kind of beverage that it specializes in. And I think it's an acknowledgement that what happened 7 years ago didn't work. The thing that would surprise me actually is that if the soft drink side of the house was bigger than the coffee side of the house. I think when people think of like Dr. Pepper, they think of the soft drink. Now, like when these companies are going to be split, my hypothesis would be that Keurig plus Peet's is actually bigger than just Dr. Pepper.
Agreed.
And so, right. And so I think that's one thing, like the brands, I think are like maybe not as strong as like actually the size of the business, right? Like Dr. Pepper is a stronger brand, especially in the US, than Keurig or Peet's would be. But the global coffee market is just so much more consolidated. Like, and when this transaction goes through and when the split happens, I'm going to be paying more attention to Keurig and Peet's than I will be to Dr. Pepper because they're just going to be a larger company. And as you can see here, they're going to hold about 20% of the consumer packaged goods coffee market. Like Nestle and them are going to be going toe to toe for dominance inside of that space. And that's going to be an interesting story to see play out.
Agreed. And I mean, I think part of the thesis around Keurig was probably the acquisition of Keurig in the first place was around the fact that coffee was growing faster than soft drinks. I mean, we've seen this when we looked at Pepsi. We saw this when we looked at Coke. They basically are these like coupon clipping businesses that are sustainable, but with rising costs, diversification of brands inside those spaces, and the like off shelf focus on new insurgents like sparkling water, for example, taking huge share in the packaged beverages space. You just have generally seen like these businesses look somewhere else. I think you can even see it here at 20% of the global CPG coffee market. Nestle and Peet's Keurig will have the two of those. By the way, they've got to figure out a better name than that one. But those, to create an entity that will acquire 20% of a highly fragmented market like coffee, to me is pretty fascinating. So there is no other player that's going to be anywhere close to the size of either one of those. But I think the bet is on coffee here, right? It's not on the actual separation of the business. And I think that Dr. Pepper is going to be this cute little brand that's left behind. I honestly, I didn't know that KDP was publicly traded. For some reason, I came into this call thinking that they were private. And I think largely it's just because I don't know the numbers for Dr. Pepper as well as I do for other kind of entities. And I think that would be another place that I'd want to start. But again, like if they break it out in the 10K between the two divisions and you look at revenue and you look at growth, like I'm sure that Keurig has grown faster than Dr. Pepper in the last 7 years since the acquisition.
So Dr. Pepper, just the soft drink side of the house, would have about $11 billion in annual revenue. So that's so I mean, it's a decent sized company, but it's not earth shattering by any means. But that includes Dr. Pepper, 7-Up, Snapple. You've got energy drinks inside of that portfolio as well, right? Like the brand is Dr. Pepper, but there's a whole kind of portfolio of soft drinks and other kinds of drinks underneath that brand.
Forgot about Snapple. I actually remember
they've carved out
a long story about Snapple. That would be a fun one to revisit. Go ahead.
No, I think they just carved out a nice little niche inside of that, inside of the soft drink space. I think to me, they're seen as an edgier brand. They're seen as a more innovative brand as opposed to Coke and Pepsi, right? They're a little bit different. I think they've done a really good job of that branding and differentiation, comparing their portfolio to Coke and Pepsi. It's obviously smaller, but I think they lean on bolder flavors and bolder marketing to kind of carve out that niche. The other thing that I'll just quickly mention, I'm sure that you've got more you want to say on this as well, but when we look at the coffee market, I also think of geographic diversity here. We were talking about distribution earlier, right? Like Keurig is a North American brand. Keurig also owns Green Mountain. So if you have drank Green Mountain coffee, if you drank Keurig, it's the same parent company. Peet's is has primarily distribution in Europe and Latin America. And so, what you're seeing here is a tie-up between coffee companies that have distribution in different parts of the world And when we were talking earlier about some of the synergies that can arise from that, a lot of that's just because they have different geographic footprints. And I think that's just important to acknowledge.
And, I think my curiosity was that strategic, or is that right? Does it make sense to sell Keurigs in Europe? Europe is generally looking for lower footprint, lower environmental footprint types of coffee. The highest environmental footprint you can get is a single serve cup. There's, not the reusable ones, so maybe that's the play. But you already also have a huge competitive set in Nespresso, from the Nestle focus, right? So similar actually business model where you sell a machine and then you refill the pods. Um, but the pods are smaller, different
And,
taste profiles. Like, I don't even know if
and,
Keurig Dr Pepper can compete or Keurig specifically in the European market. And I
and they
would
might not be trying to.
and
Maybe
I
that's
don't
why
know
they're
if that
looking at
makes
cost
sense. I don't
synergies.
know if you think about, because that's one synergy you could put on paper that may just
Mhm.
not play out, right? Hey, like
Mhm.
Keurig isn't selling in Europe very much. Well, it might be because they don't want it. It might be because they've tried. It might be because they haven't tried and they haven't figured out that they don't want it yet.
My
It might
guess
be because
is,
there's opportunity they haven't explored. It could be a lot of different things, but sometimes you
yeah,
put that stuff on paper and it's
I
not
don't think
real.
that's the play. I don't think the play is to like make Keurig like the European coffee choice. I think the play is just we have one combined entity. We have a single back office. We have increased supplier power. We have like stronger retailer relationships across continents. And so like we continue to double down on Keurig in North America and Pete's in Europe and Latin America, but like we just have more leverage as we do that. I think that's probably the way they're thinking about it.
Yeah. Well, and you can see it even here, right? There is some commentary about it. I just don't know how this factored into the model. And
Mm,
that's what I would want to get my hands on. I want to put my fingers straight into the numbers. But right, North American footprint will complement the European presence.
mm.
To me, I mean, almost every deal that has a North American opportunity is looking at the North American opportunity, right? It's not like, hey, like how can we get Keurig into Europe? It's like, how can
It's how do we
we
get more Pete's into
more
North America?
Pete's into North America, exactly.
Yeah.
And then also they're talking about emerging markets. So they're not actually really talking about the complement, but if 20% of the global market share isn't Europe and North America, you've got to factor in Asia and Latin America and emerging markets in Africa as well. And so Nestle is really well positioned in those markets already. But I would estimate that those in those fast growth areas, this combined entity would have a better play. I don't actually know which product I would lead with, pizza or Keurig, but that's maybe a later discussion.
Mm.
But I do think that there is opportunity potentially to maintain global share, but you won't be able to maintain global share if you don't go after Nestle in those emerging markets, because as the markets grow faster, the share is going to bias in the product mix toward those markets. Oh God, Naman. These are the names,
Those have to be just like
deal
the
names.
legal names, but that's not how they're going to market.
I want
So
to
that
know.
tells me, I mean, that tells me that they're going to continue to go to market under each sub brand.
So for those of you that are listening and not watching, end of this article says the new entity is called Beverage Co. and Global Coffee Co. will be led by Keurig CEO Koper and CFO Sudhanshu Pradarshi, respectively. I don't know. Let's find out. Let's put a $1 bet on this. Anybody who's listening, what do you think the go-to-market names are going to be of Keurig Dr Pepper, Snapple, Pete's when they come out on the other side? We'd love to know what your submissions are. So make sure you leave us a comment or send us a message, podcast@managementconsulted.com.
That might even be like the stock ticker, but yeah, there's no way you're going to market with those names.
You say that now, Naman. One bet, it could be that this is it. This is the new name.
Let's look below. I think that they start to spill some of the numbers here below. They took a long time in this article to get here.
Dang. All right, let's go.
Yeah. Yeah, here we go. Coffee is going to be bigger than soft drinks, right?
Mhm.
So the combined coffee company will be 16 billion annual revenue.
Yep.
Beverage Co will be 11 billion annual revenue, as we've already mentioned. And you can see here that the coffee market's $400 billion market size, and interesting here, the global coffee market is 400 billion. North America's refreshment beverage market is 300 billion. I think that just tells you right there the importance of the North American market compared to any other market in the world.
That number doesn't track with the number that we saw earlier. I don't understand how Nestle and Global Coffee Co. could both have 20% share
20%.
if it's 16 billion in sales out of a
Yeah,
400
because
billion
that's
dollar
an
coffee
$80
market.
billion, because 20% would be $80 billion.
This tracks more with the fragmentation I was expecting to see in the coffee market. I mean, if you walk into the store, anytime that you walk into an aisle and you see like cereal is actually pretty consolidated, right?
Look,
You
this
have
is,
just a couple of different like brand names, but you have a couple of providers in the cereal
let's break
space.
this
But
down.
for
I think this
coffee,
is,
it's different.
yeah, let's break this down for a second. I think this is like classic Reuters, okay? And I'm not throwing shade at Reuters, but like what they mentioned earlier was 20% of the CPG coffee market. And now they're talking to you about the global coffee market. And so they're adding in a new metric here, which, okay, is helpful. But yes, if you're kind of reading and doing the math, you're like, wait, what the heck? Where are these numbers coming from? Nestle and Peet's are going to have 20% of the CPG coffee market, not the global coffee market. So I think what's missing here is, okay, out of the global coffee market, it's $400 billion. Like, how big is the CPG coffee segment? And that's the data here that's missing.
Okay. I also wanted to just say here, we talked a little bit earlier about the purchase. So this is it, right? We talked a little bit about understanding who's actually selling these shares. Peet's wasn't private, but nearly, right? So 68% is a massive controlling stake in a company. So without this, there was no way for anybody to get a deal done. So this was potentially more of a back channel deal rather than a competitive deal. And it just was like, hey, what's it going to take to give us the tender share of these offers? Without it, they could have blocked any deal, any vote, any board deal. There's no way that somebody at 32% could have acquired enough in order to overcome this. And so that 20% was their threshold that they needed in order to take this off the market. So yeah, JAB Holding, which by the way, always worth looking into some of the like legacy family investment firms, especially in Europe. These are the big players in a lot of these deals. And if you track through what they've invested in, why, and when they've sold, you can see a lot of really interesting business news. Anyhow, I think there's a lot of opportunity when you see that here.
Yeah.
I also think this is interesting, right?
It's a good deal for them because they're getting a 20% premium on the shares they hold in Peet's, and then they're going to own about 5% of the separate entities, which I think are going to perform better. So they win now, and hopefully they win later as well. It's not a bad bet from their perspective.
They also already owned a 4.4% stake in KDP, may have been the brokers of the deal in the first place.
Yeah. I think they're the ones who probably drove the 2018 transaction as well. And they're the force behind unwinding it now.
Well, I think that you've got a couple of months until we actually see this realized. But also, you'll see here, right, JDE Peet's isn't just Peet's. So there are other brands that are underneath it. And so you see the difference of kind of like, right, Keurig, JDE Peet's, and then you also see Dr. Pepper. But I think that if you look at the ownership, if you look at the sales, if you look at the market, if you look at where they're thinking to realize synergies, I haven't run the numbers, and we're not here to analyze stock prices, but I generally wouldn't think that the market was wrong on this one. I think that this is probably a great deal for the investors that were the majority shareholders, but not necessarily a great deal for the future investors of these businesses or any kind of minority investors. But we'll see. There's lots to follow.
I'll be thinking about this the next time I crack open a can of Dr. Pepper. I don't drink Keurig coffee. I don't drink Peet's either, but I'll think about this the next time I have an ice cold can of Dr. Pepper.
Amazing. Well, thanks, Simon. I really enjoyed the conversation today. If you have a business article like this one where you want to see a little bit more than what meets the eye, we'd love to hear it from you. You can just send us a link to it directly. But behind a paywall, we'll figure it out. And we're also really excited just to talk about business news that doesn't hit financial markets. As you know, on Market Outsiders, our play here is everything in business, not necessarily public businesses only. So please make sure that you've sent us your insight. And if you haven't already, subscribe to the podcast, follow along, and share it. We love it when you give us the honor of believing that what we do here is valuable enough to share with your community. So thank you again for joining joining us today. That's today's Market Outsiders. Real insights, real fast. Join us live each weekday at 9:15 a.m. Eastern on LinkedIn and YouTube. But make sure you're subscribed to catch all the action as it unfolds. If you have questions or a story you want us to cover, reach out anytime to team@managementconsulted.com. Plus, if you love Market Outsiders, share it with a friend or colleague. We'll catch you next time on Market Outsiders.